We just finished allocating our indirect costs. Now we're going to allocate our service costs. So first of all, let's determine how much costs we're going to allocate. We said that purchasing had direct labor of $49,000, and then they were allocated an additional $3,500 of indirect costs. So the total amount of service costs to be allocated is going to be $52,500. Just put that. Payroll had direct labor costs of $41,500. They were allocated indirect costs of $3,500, so the total payroll cost to be allocated is $45,000. IT had direct labor of $63,000. They were allocated an additional $7,000 of indirect costs, so total IT cost to be allocated is $70,000. Okay, now we know how many costs we want to, or how much we want to allocate. Let's figure out how we're going to allocate it. Purchasing is going to be allocated based on the number of purchase orders. And we know that boots had 20 purchase orders, sandals had 15, and athletic had 70. So there were a total of 20, 15, 35, 105 purchase orders. When we divide 52,500 by 105 purchase orders, that tells us that we are going to allocate at a rate of $3,000 per purchase order. $3,000 per purchase order. So for every purchase order, they're going to be allocated $3,000 of purchasing costs. All right, our payroll department is going to be allocated based on number of employees. There are 15 total employees. And when we divide 45,000 by 15, we find out that, oh, I have my numbers wrong. You're probably all screaming at the video right now. Purchasing, we're going to allocate $500 per purchase order. It's payroll that will be $3,000 per employee. EE is for employee. Okay, so purchase orders, when we did 52,500 divided by 105, $500 per purchase order. Payroll, 45,000 divided by 15 total employees, 3,000 per employee. IT is going to be based on the number of service tickets each department used. Okay, so they call the help desk, that's a service ticket. They say something's not working. Hopefully IT helps them. All right, IT costs were total $7,000, and our total IT service tickets is 70. So that means we're going to allocate IT costs at $1,000 per service ticket. All right, now that we know how we're going to allocate our service costs, let's go back over to our main spreadsheet and get these allocated out, and then we'll calculate our net income. Now we're ready to allocate our service costs. We calculated that purchasing would be allocated at a rate of $500 per purchase order from each department. Payroll was allocated at a cost of $3,000 per employee, and IT is allocated at a rate of $1,000 per service request. So we have the number of each of those things that our profit centers used. So it turned out that Boots opened 20 purchase orders. So their allocation of purchasing costs is $10,000. Sandals had 15 purchase orders. So their allocation of purchasing costs is $7,500. Athletic had 70 purchase orders. So their allocation of purchasing costs is $35,000. And when we add that all up, it equals $52,500, and we are going to deduct that from purchasing. So that purchasing net income is now zero. They incurred $52,500 of costs, and we've allocated those out, so they're now zero. All right, let's go on to payroll. Payroll, we determined, was going to allocate their costs at a rate of $3,000 per employee. Boots has 5 employees, so they are going to get $15,000 of payroll costs. Sandals has only 3 employees, so they're going to get $900 of payroll costs. $9,000 of payroll costs. And Athletic has 7 employees, so they will get $21,000, 7 times 3,000, $21,000 of payroll costs. When we add up everything we allocated, we have $26,45,000, and we're going to subtract that from the payroll cost center. And now payroll's net income is zero. Finally, we're going to allocate the $70,000 of IT costs. We determined that the cost that we would allocate is $1,000 per service ticket. Boots opened 18 service tickets, so they're going to get 18 times 1,000, $18,000 in IT costs. Sandals opened 32 service tickets, so they're going to get $32,000 of IT costs. Athletic opened 20 service requests, so they're going to get $20,000 of IT costs. If we add these up, 18 plus 32 is 50, plus 20 is 70, and we've allocated all of our costs. We'll go ahead and subtract them from the IT cost center so that they will have zero net income. Okay, we've allocated all of our costs. We started by identifying sales and direct costs. Then we allocated our indirect costs. Finally, we allocated our service costs. So now let's add up how much service cost was added to each department. And I've done the same for indirect. So indirect costs allocated to Boots was $71,000. Service costs allocated to Boots was $114,000. Indirect costs allocated to Sandals was $39,000. Service costs allocated to Sandals was $87,500. Indirect costs allocated to Athletic was $95,000. Service costs allocated to Athletic was $171,000. So now, for each of our profit centers, we'll take our gross profit minus our allocated indirect costs minus our allocated service costs, and that will give us net income. So it turns out that our net income for the Boots Profit Center is $80,000. Sandals has a net loss of $4,500, and Athletic has a net income of $34,000. Now this information is useful because we may say, hey, Boots, that's our best department, right? But now we have to look at what time of year it is. In October, Boots is our best department. In May, it's probably terrible, right? Athletic, $34,000. There may or may not be some seasonality to that. Sandals has a negative net income of $4,500. We may say, well, maybe we shouldn't be selling sandals anymore. But again, if we're in boot season, then it would make sense that sandals would be low.